Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Unity.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine a tech giant whose stock just plummeted nearly 30%, practically overnight.
Yeah, just an absolute bloodbath on the charts.
Right. To the general public, it looked like a total disaster, just a sinking ship. But while retail investors were, panic selling, the smartest institutional billionaires on Wall Street were quietly stepping in.
Scooping up millions of shares at a massive discount.
Exactly. So today, we are bypassing the surface-level noise of this really violent stock chart. Our mission is to examine the underlying financial mechanics and really the immense wealth-building potential here. Because over the next 6 to 12 months, they are executing one of the most aggressive fundamental pivots in recent tech history.
They really are. It's an incredible shift.
Yeah, they're attempting to transform from this structurally challenged, low-margin legacy ad network into a premier, high-margin artificial intelligence platform. And the mechanics of how they are doing it will completely change the way you view the entire tech sector.
It's a masterclass in corporate restructuring, honestly, and it is dominating financial conversations right now precisely because this is no longer just a story about video games.
Right, which is what everyone thinks of.
Exactly. For years, the broader market boxed them into this very specific corner, viewing them simply as the software engine that developers use to build mobile apps and games.
Which, is a huge business, but it's limiting.
Highly limiting. And relying on that outdated narrative is how investors miss massive opportunities. What we are actually witnessing right now is an operational turnaround heavily focused on cutting-edge AI and advanced advertising technology.
And I want to dive straight into the numbers, because to really grasp what is happening here, we need to look at their recent Q4 2025 performance.
Oh, the metrics are incredibly telling.
They really are. So they reported top-line revenue of $503.1 million. That comfortably beat Wall Street's estimates of $491.4 million.
A very solid beat.
Yeah, and adjusted earnings per share came in at 24 cents, which is a 17% beat. But, those are just the headline numbers. The absolute star of the show here, the engine driving this entire turnaround thesis, is their Vector AI-driven advertising platform.
That's the crown jewel right now.
Exactly. Vector grew an astonishing 53% over its first 3 quarters. And then it accelerated. It had a record January in 2026, up 72% year over year.
Wow.
I know, right? Management is now projecting a staggering $1 billion annual run rate for Vector by the end of 2026.
Those growth metrics for Vector are, frankly, the absolute linchpin of the entire thesis, and the preliminary Q1 2026 numbers they just released completely crushed their own prior guidance.
They really blew it out of the water.
They did. We are talking about expected revenue between $505 and $508 million, and adjusted EBITDA coming in between $130 and $135 million.
Okay, let's unpack this, because we throw around terms like adjusted EBITDA a lot, and it's important to clarify exactly why that matters to you as an investor. EBITDA essentially stands for earnings before interest, taxes, depreciation, and amortization.
Right. It's the raw operating profit.
Exactly. And when we look at adjusted EBITDA, we are stripping out the messy accounting noise like non-cash stock-based compensation. We do that to give you the clearest possible lens into the actual operational cash-generating power of the core business.
Precisely. It shows you the actual cash heartbeat of the company. And when you isolate their strategic grow revenue, which essentially strips out all the declining legacy baggage they're trying to leave behind, that segment jumped 48% year over year.
That is massive growth for a legacy company.
It is. Plus, they are executing this entire pivot from an absolute financial fortress. They are sitting on over $2 billion in cash and equivalents right now.
$2 billion. That's a huge safety net.
Huge. And their free cash flow for 2025 was over $403 million, which is up nearly 48% year over year. At the same time, their GAAP net losses, the official accounting losses, are narrowing significantly.
I look at these margins, and I have to admit, my initial reaction is a bit skeptical.
How so?
Well, think about it like rebuilding an airplane engine mid-flight. They're shedding these heavy, low-margin legacy parts like their ion source ad network to basically strap on a high-powered AI jet engine with Vector. But they are a game engine company trying to pivot incredibly hard to play in the advertising sandbox dominated by titans like Meta and Google.
It's a crowded sandbox.
very crowded. And management is projecting free cash flow margins to grow from 21.8% in 2025 to 25.7% in 2026. That sounds fantastic on paper, but historically, the costs associated with these massive corporate pivots usually eat those margins alive.
That's a very fair point.
Right. So why is this time any different? How do they just flip a switch and become this highly profitable AI advertising powerhouse?
Well, it is different this time because of the fundamental nature of the product they are swapping in versus the product they are swapping out. They are currently displacing low-margin legacy revenue with high contribution AI revenue. Let's break down the mechanics of why that matters.
Yeah, let's get into it.
Advertising technology, at its absolute core, is entirely about targeting efficiency. In the past, they relied on older, broader ad networks like ironSource.
Right, think of a legacy network like a billboard on the side of a busy highway. You are paying a premium just hoping that the exact right demographic happens to drive by, look up, and actually care about your product. It's a scattershot approach.
Exactly. You're paying for eyeballs, not necessarily conversions. But the Vector AI model is completely different. Vector is like having a digital concierge walking right next to the consumer.
Oh, I like that analogy.
Thanks. Yeah, it is an AI-native platform that can target users with unprecedented precision. Because it is so accurate, advertisers are willing to pay a massive premium for those ad placements. And because Vector is driven by algorithms rather than heavy manual network operations, the internal cost to serve those highly targeted ads is substantially lower relative to the premium they charged.
So the margins just naturally expand.
Precisely. They aren't just changing what they sell, they are fundamentally upgrading the profit margin on every single dollar that comes through the door.
That makes perfect logical sense. The AI is more efficient, so the margins expand. But here's where it gets really interesting. An AI model is ultimately only as good as the data feeding it, right?
Oh, absolutely. Data is the new oil.
Exactly. An engine, no matter how sophisticated, needs high-quality fuel. Every major tech company on the planet is building an AI model right now. So what stops a well-funded open-source competitor from just copying this algorithmic model? And code is just code, right? Can't somebody else just build a better mousetrap?
They could absolutely build a similar algorithm, but what's fascinating here is the single most important aspect of this entire company, their data moat.
The moat.
Right. An open source competitor might build a brilliant AI algorithm, but without a massive proprietary fire hose of unique data to train it on, that algorithm is completely useless. Unity has a structural advantage that very few companies on Earth can match, and it stems entirely from their pervasive real-time 3D ecosystem.
Right, because they power the vast majority of top-selling virtual reality games, and they are the absolute foundational backbone of the MetaQuest platform.
Yes, over 90% of developers using their platform have explicitly opted into their data framework.
90%?
90%. You simply cannot replicate or copy that level of market penetration. Because their software is running the actual underlying physics engine of the game or application, they aren't just tracking what a user clicks on a web page. And this brings us to a massive upcoming catalyst in Q2 2026, the integration of runtime engine behavioral data directly into the Vector AI models.
Okay, we really need to unpack runtime engine behavioral data, because this is the mind-blowing part of the story for me.
It's revolutionary.
Right, a traditional ad network, like what you experience on a web browser, it tracks your clicks. They use cookies to follow you from site to site, basically guessing what you might want based on your web history. But runtime behavioral data means they are tracking your actual physical behavior inside a three-dimensional simulation, right?
That is exactly the distinction. Because they run the physics engine, they know how you navigate a 3D space. They can measure micro-hesitations. If you were in a virtual environment and you pause to look at a digital item, they track the precise dwell time.
That is incredibly granular.
It is. They track the physics of your engagement, the movement of your controllers, your spatial awareness. That level of deep behavioral psychology data is incredibly predictive for advertising. When you integrate that directly into the Vector AI, you get a compounding exponential improvement in ad performance.
And the beauty of this is that it completely bypasses all the modern tracking roadblocks.
Oh, entirely.
Like Apple introduced app tracking transparency a few years ago, which essentially allowed iPhone users to block apps from tracking their data across other apps. It absolutely devastated the revenues of companies that relied on browser cookies. But because this company is gathering data natively from within the physics engine of the app itself, they don't need a third-party cookie. The user's physical behavior inside the simulation already told them everything they need to know.
which is an incredible insulating moat against commoditized ad networks. And to solidify this dominance even further, on April 8th, 2026, they announced an extended multi-year virtual reality partnership with Meta that completely cements their status as the absolute, undisputed go-to platform for this kind of development.
Okay, so let's summarize where we are. We have a company with a rapidly expanding margin profile, an impregnable behavioral data moat, a multi-year foundational partnership with Meta, and a high-powered AI engine that just posted 72% growth in January.
Sounds like a dream scenario.
It does.
Yeah.
But if the underlying fundamentals are that spectacular, we have to address the elephant in the room. We have to talk about the terrifying reality of the stock's recent price action. Because if you look at the chart the morning after their Q4 2025 earnings release, you would have thought the company was filing for bankruptcy.
The market reaction was a brutal case of technical whiplash, no doubt about it. Following that Q4 report, the stock suffered a violent gap down of nearly 30%, touching a low near $18.36.
30% in a day is just jarring.
It is. When a stock plummets that fast, it creates widespread psychological trauma in the market. Retail investors panic, institutional algorithms automatically trigger stop losses, and the selling pressure just accelerates into a free fall.
But then the script flipped completely. After finding that bottom, we recently saw a 15.39% monthly gain and a 20.95% return in just a 7-day window.
A classic V-shaped recovery.
Very sharp. Now, part of that rapid bounce is due to the stock's volatility profile. This asset currently has a beta of 1.998. For those unfamiliar, a beta of 1 implies a stock moves exactly in tandem with the broader market. A beta of nearly 2 means it is basically twice as volatile.
Right. It swings big in both directions.
Exactly. If the market goes up 1%, this stock goes up 2%. If the market drops, it drops twice as hard. This creates wild swings. And during that massive swing, there was some incredibly suspicious-looking activity in the SEC filings that I want to push you on.
You're looking at the insider trading flow.
I am. And I'm looking at it from the perspective of an everyday investor who's being asked to believe in a turnaround story. Over the last 6 months, there have been 39 insider sales and 0 insider buys.
Right.
The chief financial officer and the chief accounting officer are literally dumping shares. Why should you, the everyday investor, hold the bag and trust this company when the executives managing the money are aggressively selling?
Look, it is a completely fair and necessary question, but it requires us to look past the surface-level optics and understand the actual mechanics of corporate compensation. Those 39 sales are what we call cluster selling, yes, but they were all executed under pre-planned 10b5-1 plans.
Let's explain what a 10b5-1 plan actually is, because the context completely changes the narrative.
Absolutely. High-level executives are usually compensated heavily in restricted stock units in order to pay the massive tax burdens when those shares vest, or to simply diversify their personal wealth without being accused of insider trading based on material non-public information. They set up automated selling plans.
They schedule it in advance.
Exactly. These 10b5-1 plans are established months, sometimes years in advance. They dictate that a specific number of shares will be sold on a specific calendar date, regardless of what the stock price is doing. The CFO didn't wake up, look at the 30% drop on the chart, panic, and hit the sell button. A computer executed a legal mandate that was filed a year ago.
So to the retail investor, the optics look terrible. It looks like rats fleeing a sinking ship. But in reality, it's just scheduled corporate tax management.
Exactly. And more importantly, you have to contrast that scheduled, automated insider selling with what the true institutional smart money was doing during that exact same 30% gap down.
Right, the billionaire.
Yes. When the stock crashed to its absolute nadir around $18 in Q4 2025, Fidelity stepped in and added 2.8 million shares to their position. D.E. Shaw added another 2.8 million shares.
That is massive volume.
Massive. These are sophisticated financial institutions with armies of analysts. They looked at that panic selling, ran the numbers on the AI margins and the data moat, and saw a deeply discounted generational buying opportunity. They bought the absolute bottom.
That is the ultimate signal of long-term conviction. And the broader analyst community clearly agrees with Fidelity. Right now, 18 out of 27 major analysts rate the stock a buy. And the price targets they are issuing imply massive upside from current levels.
Oh, yeah, the street is very bullish.
Morgan Stanley recently raised their target to $32. BTI maintained their buy rating with a $39 target. Wedbush reaffirmed their outperform rating with a $30 target. So the big money and the top-tier analysts are entirely looking past the surface-level volatility.
They are ignoring the noise because they are focusing strictly on the underlying mechanical shift we discussed earlier. The transition from a low-margin legacy multiple to a high-margin AI multiple.
But look, we would be doing you a massive disservice if we only presented the bullish, rosy narrative. To give you the complete wealth-building context, we have to look at the very real structural risks that could derail this entire turnaround.
Always have to look at the downside.
Because no investment is a sure thing, and you don't get a 30% gap down without real anxiety hanging over the broader market. There is a very prominent bear case right now centered entirely around macroeconomic sector fears.
Yeah, there is a significant headwind in the broader software as a service and AI sectors today. We recently saw Q1 earnings reports from massive legacy tech titans like IBM and ServiceNow, and their forward guidance really dragged down the overall software sector.
The way I see it, we're hitting the hangover phase of the AI boom. It's like a gold rush, right? For the last year, companies have been spending billions of dollars acquiring AI capabilities, and investors have been throwing money at any company that so much as mentions artificial intelligence in a press release.
Just blind buying.
Exactly. But now, the honeymoon is over. The market is suddenly pausing and asking if the shovels are actually finding any gold. They are demanding actual proof of a return on investment. If a company is spending millions on AI infrastructure, but it isn't driving tangible new revenue, Wall Street will punish them. That sector-wide anxiety is pulling everyone down.
And if we connect this to the bigger picture, that anxiety is exactly why their high beta is a double-edged sword right now. When the broader sector drops due to AI monetization fears, they get pulled down aggressively with it. But as an investor, you have to clearly differentiate between speculative concept AI stocks that only offer promises and companies that are actually generating cash today.
Right, tangible results.
Unity's Vector platform isn't a theoretical promise. It posted 72% year-over-year revenue growth in January. It is proving real, measurable return on investment to advertisers right now.
Even with that proven, tangible ROI, they still face incredibly fierce competition. They're not operating in a vacuum. Ad tech rivals like AppLovin and even their foundational partner Meta are constantly competing for the exact same advertising budgets.
Oh, the competition is fierce.
Plus, there's a massive execution risk hanging over their heads. We spent a lot of time talking about that upcoming Q2 2026 integration of runtime behavioral data into the Vector platform. If management fumbles that integration, like if the complex 3D data doesn't actually boost ad performance the way they promised, Vector's hypergrowth could hit a brick wall.
Execution risk is paramount in any corporate turnaround of this scale. However, when you look at this through the lens of a risk-to-reward ratio, there are massive mitigating factors. Because the stock had already dropped roughly 56% in 2026 before its recent V-shaped bounce, an enormous amount of that failure risk is already priced into the current valuation.
So the market already expected the worst.
Exactly. Wall Street essentially priced the stock as if they expected the pivot to fail. Furthermore, by sunsetting their legacy products, they are completely removing their most vulnerable, underperforming competitive segment.
Which brings us perfectly to the actionable catalyst calendar. If the downside is mostly priced in, what actually moves the needle next? What exactly should you be watching over the next 3 to 6 months?
There are some major dates coming up.
The most immediate and critical date is April 30th, 2026. That marks the official sunset of the legacy IronSource ads network. They are finally completely severing the deadweight. Let's talk about the mathematics of this. What happens psychologically and financially to a company's valuation when it officially amputates its worst-performing segment?
It creates an incredibly powerful mathematical and psychological trigger for the market. When a company is carrying a large, declining legacy business, it drags down their blended growth rate. Analysts look at the overall top-line revenue, and because the legacy business is shrinking, the entire company looks sluggish.
Right, it masks the good stuff.
Exactly. But the moment you drop that anchor and cut off the declining segment, suddenly the hyper-growth of the remaining business in this case, the Vector AI platform becomes the dominant, isolated narrative. The overall growth rate of the company artificially accelerates practically overnight, simply because the anchor is gone.
And right after they drop that anchor on April 30th, they face the ultimate test, their upcoming earnings call on May 7th, 2026. The analyst consensus is expecting 24 cents in adjusted earnings per share, which would represent a staggering 226% jump year over year.
Massive improvement.
Yeah, and they're expecting top-line revenue of around $500.7 million. Now, considering they already released preliminary Q1 numbers that completely crushed prior guidance, the probability of a massive upside surprise and raised forward guidance on May 7th seems incredibly high.
The setup for that May 7th earnings call is extremely bullish. And to add fuel to the fire, there is a very credible speculative catalyst currently floating around the market. There are strong whispers that management is actively exploring the sale of their supersonic game publishing unit.
A divestiture like that would be massive. If they successfully sell off the publishing unit, not only does it further streamline their operational focus strictly onto the high-margin AI platform and the core physics engine, but it would bring an enormous immediate cash infusion right to the balance sheet.
Exactly. When you synthesize this entire timeline, you begin to see a highly cohesive, accelerating momentum story building for the remainder of the year. You have the iron source sunset eliminating the dead weight on April 30th. You have the highly anticipated, likely market-beating earnings call on May 7th. You have the critical Q2 runtime data integration into Vector shortly after that, which will supercharge ad targeting. And you have a potentially massive cash-infusing divestiture waiting in the wings.
It's a loaded calendar.
It really is. This perfectly aligned sequence of events is why the final quantitative score for the stock right now is a solid 8 out of 10 bullish rating.
So the play here is framed as a medium-term hold, looking at a 6 to 12-month time horizon. The strategy isn't necessarily a quick day trade based on chart volatility. The real wealth-building strategy is to hold the asset and capture the multiple expansion that occurs when Wall Street finally capitulates.
That's the key.
Right, the market has to stop valuing this as a declining game engine company and start valuing it for what it actually is, a premier hyper-growth AI advertising platform.
And that re-rating process is where generational wealth generation happens. A multiple is simply what the market is willing to pay for a single dollar of a company's earnings. A legacy software company might trade at a low multiple, say 3 or 4 times revenue. But a high-margin AI platform routinely trades at 10 or 15 times revenue.
That is a huge difference.
When a company successfully executes a pivot and moves from that low-margin multiple to a high-margin multiple, the stock price can double or triple, even if the underlying revenue stays perfectly flat. But in this specific case, the AI revenue isn't flat. It's actively growing at over 70%. It is a compounding formula for explosive upside.
So to recap the core narrative we've unpacked today, we are looking at a tech giant that the broader market aggressively and perhaps foolishly discounted. They endured a brutal technical whiplash, dropping 30% and shaking out all the weak retail hands.
Knock 'em right out.
Yeah. But underneath that terrifying surface volatility, they have been surgically shedding their legacy baggage to focus entirely on dominating the future of AI advertising. They're backed by over $2 billion in fortress-level cash, protecting them from macroeconomic credit crunches. And the smartest institutional money on Wall Street, the firms that dictate market direction, aggressively bought the dip when everyone else was panicking.
The smart money knows.
They really do. And they have clear, undeniable, and immediate catalysts lined up over the next few months to definitively prove to Wall Street that this operational turnaround is succeeding.
It is a textbook example of finding deep value where the broader market only sees chaos. By truly understanding the underlying mechanics of their expanding free cash flow, the unique power of their runtime data moat, and the reality of scheduled 10b5-1 insider sales versus massive institutional buying, you can clearly see the fundamental strength of the asset that others are simply missing.
I want to leave you with a final lingering thought to ponder on your own. We spent a lot of time talking about their massive data moat. In fact, they're deeply embedded in the actual runtime physics engine of 3D applications and virtual reality headsets.
The best data in business.
Right. So if they successfully leverage that physical in-engine behavioral data to target ads flawlessly, if they can entirely bypass traditional browser cookies and completely avoid the app tracking transparency roadblocks that have plagued digital advertising for years, does this company quietly hold the blueprint for the entire future of digital advertising, far beyond just gaming and mobile apps? Think about that. Thank you so much for joining us on this edition of Smart Wealth. Our goal is always to equip you with the actionable, high-level financial insights you need to block out the noise, understand the mechanics, and build real wealth. See you next time.